All right, we're going to talk about the chapter 2 of the Datar text. So I would assume that you have read the chapter by now. If not, you will read the chapter shortly after. You can get the order of these whichever way helps you most. But what we're going to do in here in this chapter, I'm going to walk through it. I also would encourage you to print this off from Moodle. So this exact handout is on Moodle, and you will see that the solutions are in back. So it may be useful to look at the solutions as you work through it. So the first thing we're going to do is define and illustrate a cost object. A cost object is anything you want to cost. So for instance, it is usually a product. So if I am making t-shirts and I want to know how much I need to sell my t-shirts for, I need to figure out their cost. So the t-shirt, the product, is the cost object. Sometimes you want to determine the cost of a division, or let's take this school. You might want to determine the cost of the School of Business, or the cost of the science department, or the cost of a certain athletics team. So that is whatever in the world you want to cost. That's your cost object. This is kind of important because direct and indirect are certainly different as far as your cost object. So for instance, if I was going to, my cost object were the academic units of Quincy University, certainly the Vice President for Academic Affairs salary would be a direct cost for that cost object. However, if I was going to figure out the cost of the School of Business, the Vice President for Academic Affairs would be an indirect cost because she oversees the School of Business and the School of Science. So that's the importance of a cost object. Direct cost, we just talked about that with the cost object. So again, if I was going to cost the academic units versus, we've got basically student services at Quincy University, academics, and various other areas at Quincy University. But if I was going to figure out the cost of the academic units, the Vice President for Academic Affairs that oversees all of the faculty would be a direct cost, whereas the salary of that position would be an indirect cost if I was going to figure out the cost of the School of Business. Variable costs and fixed costs. Variable costs are costs that vary basically based on your cost object. So if I'm going to cost a product, for example, t-shirts, variable costs would be costs that vary with the more t-shirts I make. So I'm going to have the material fabric for the t-shirt being a variable cost. So when we get down below, we'll find out that direct materials and direct labor are usually variable costs. Fixed costs are costs that don't change no matter how many I make. So for instance, the rent for the store, property taxes, salaries of people would be fixed costs. So think about your cost object and say, okay, my cost object is t-shirts individual t-shirts because I want to sell them. So the more t-shirts I make, does the fixed cost go up? And the answer is no for rent and property taxes. So it's the same whether I make one t-shirt or 100 t-shirts, that's a fixed cost. Interpret unit costs cautiously. The reason your textbooks talks about this is because fixed costs are in unit costs. So for instance, let me pause here a second. Okay, let's take this simple example. Let's say that my variable cost, so again, I'm making t-shirts. I have $10 of variable costs, so that would be the fabric for the t-shirts and the worker's salary, the worker's hourly wage that works on the t-shirts. And I make 100 t-shirts, so I have variable cost of 100 times 10. So again, let's just pretend I buy the t-shirts. So I buy them for $10, I buy 100 of them, so I spend $1,000 on t-shirts. Okay, and then I am charged rent of $2,000, so my total cost for my t-shirt is $3,000. So my unit cost is $30, which is the 3,000 divided by 100. Okay. But look at what happens if I make 120 t-shirts, okay? If I make 120 t-shirts, my cost goes down to $26.67, and so the reason is because I'm spreading these 2,000 units over the 100 shirts. So if I have whoops, 120 shirts. Okay, so look what happens when my fixed cost per unit, when it's 100, it's $20, but when it's 120, it's $16.67. So my total costs go down. So the point of this particular statement is, and interpret unit costs cautiously, has to do with if you only are utilizing this number in your analysis, you will miss something because let's say, oh, now I want to make 130 costs, or 130 shirts. So if you take 130 shirts, I'll say, okay, my total cost is $34.67, and that's wrong because of fixed costs. So my total cost is actually $3,300, not $34.67. And that's because of fixed costs. Fixed costs are spread over more units. So that's what they mean by interpret unit cost cautiously. Okay, so let's go back to here. Distinguish inventoriable costs from period costs, which we'll talk about in just a second. And we'll talk about the flow of inventoriable and period costs. Okay, so here's two types of financial statements. You will utilize both of these quite a bit in here. You might think that pretty much, well, I'll talk about this, but look, both of them have sales, so this number is going to be the same. And then I have my product costs attached to a product. Okay, and the three product costs are direct materials, direct labor, and overhead. So think of product costs, think of this as a factory building. If the cost happens in the factory building, then it is a product cost. So if you're thinking about a factory building and I'm making cars, we have our steel for our cars, we have the fabric for the seats, we have the engines, etc., etc. Those are all direct materials. Our direct labor are the wages of the workers actually touching the cars. So the welders, the people who are putting the cars together. And then we have a lot of other costs that incur in a factory that aren't direct materials or direct labor. So for example, depreciation on all the machines in the factory, the supervisor salary, the electricity for the factory, the earplugs for the workers, I think I said supervisor salary, and the rent for the building, the property taxes for the building. All of those are product costs because they happen in the factory. So what happens is later on, I have to spread these costs over the number of cars. So for instance, if I have a sewing machine that costs me $200 and I know that it will make 200 shirts before it breaks down, then I have to spread $200 divided by 200 shirts, or each shirt gets $1 of sewing machine depreciation. That's manufacturing overhead. Then we have period costs. Period costs, think of this as the office or the showroom, sales showroom. Period costs attach to the period. So in other words, they attach to the year or the month that they happened. So period costs, there's two types. There's selling costs and administrative expenses. So for example, if I spend $100 on advertising, I don't care which product it sells. If I spent or had the advertisement show in December, it gets recorded in December. My CEO, my accountants, my lawyers, etc. If I incur their costs in 2000 and whatever, X1, then it gets costed to that period. A product cost actually attaches to the product. So think of it this way. If I have $100 of, let's say, a supervisor salary. If I have $100 of supervisor salary and I make 100 units, each product, that's the name product cost, gets $1 of that. Okay, and then if I sell 60, cost of goods sold is $60 and ending inventory is $40. Whereas if this were a period cost, I would just put $100 right here. If it's a product cost, I have to ask myself how many is sold. So these are the ones that are complicated, where I have to figure out, attach the cost to the product, and then figure out how much is sold. Direct materials is not too difficult to attach to a product. So if I, again, go make t-shirts, I can figure out how much fabric goes into the t-shirt. I could time my workers, and for For simplicity, let's assume that it takes an hour to make a t-shirt. So I have an hour of direct labor in each t-shirt. But manufacturing overhead is the difficult one because I've got supervisor salary, I've got electricity, I've got depreciation, etc. I have to spread over the number of t-shirts to figure out the cost per t-shirt and then split it up between sold. Okay, so sometimes you will use this formal statement. So notice it's sales minus cost of goods sold, which is only the number sold. So sales based on the number sold, cost of goods sold based on the number sold. This is called the matching principle, where if I sell 100, I only want the cost of 100 items. Then it gives me a gross profit, and then I subtract my operating expenses for the period to get my operating income. Another statement that is, and notice this is for a financial statement, this is called absorption costing, where the costs of the product are absorbed into the product and expensed when they're sold. Okay, this is the one financial statements require because if you think about it, as we become less and less labor intensive, this number can be huge. So making it a product cost and only expensing it when it's sold is pretty important. However, sometimes for managerial purposes, we want a different type of income statement. We simply want to identify costs as variable or fixed. Okay, so notice direct materials is generally always variable. The more t-shirts I make, the more fabric I buy. Direct labor is, for our purposes, we're going to consider it variable. There are times in life where you consider labor fixed, especially if you're thinking in the short term. However, in the long term, you generally, if we're looking over a period of year, which is what income statements are based on, you will generally adjust your labor force based on how many you're going to make or sell. And so direct labor, we consider it variable. This is not always perfect. Sometimes labor costs, again, if you figure it out in the short term, you're not going to let it lay off people. You're not going to hire more people. You're going to have them work overtime, et cetera, et cetera. But anyway, there are complications. But for simplicity purposes, we will always figure out that direct labor is variable unless you're told otherwise. I came across a case once that they considered direct labor fixed because the certain country they were operating in had severe penalties for laying off people, so they did not lay off people, so direct labor was fixed. So and if you shorten the period of time, you're going to figure out direct labor is fixed. But for our purposes, we consider it the long term of the period of a year. Direct labor is variable because you're going to alter your workforce. Manufacturing overhead can be either variable or fixed. Okay, a lot of it is fixed. Okay, because you have a supervisor salary, it's not going to change no matter how much you make. You have rent for the building, property taxes, that's all fixed. However, you're going to have some that are variable. A lot of times if you had to choose, electricity is variable. Although in a future chapter we're going to figure out sometimes you have a mixed cost and you split out the variable and the fixed components. So cell phones, when they first came out, were like you paid $35 a month plus 10 cents a minute. So if you notice, that's a mixed cost, and that's easy to break out because it's given. But other times, like electricity, if we picture it, a lot of us would consider it a variable cost. However, you can't shut off your electricity. So if you think about the week between Christmas and New Year's, if I take off and I make zero, I still have electricity costs. So there is a variable and a fixed component, and sometimes we break that out. Operating expenses can either be variable or fixed. Think of a sales commission that varies based on the number you've sold. So if I get, X percent of every sales dollar, that's a variable cost. And fixed, I have a lot of salaries. I have the CEO's salary, the chief financial officer's salary. All the accountants, the lawyers are all generally salaried. So there's a lot of fixed down here. So it looks like this bottom line would be the same. Well, it's not, and it's not because of this. Okay, so let's go down here. Under absorption costing, you only expense the amount sold. So I'm going to put $60 right here into cost of goods sold. Okay, however, under variable costing, since I'm spending $100 no matter how many I sell, I want to put $100 over here. So this side is going to have $100 on it. This side is going to have 60. So obviously you can't have two income statements showing different numbers and use them. So GAAP specifies you have to use this one, the absorption costing, which spreads your fixed overhead over the number of products produced. This one's variable, this one's variable, this one's variable, so your variable costs are going to be the same, your variable costs are going to be the same, your fixed operating is going to be the same, but it happens here when it's a product cost, when some of my fixed costs get stuck in ending inventory. Okay, so these are the two income statements. Write them out. They're going to become important. We don't get hung up a whole lot on the fact that these two are different, but you do need to know which income statements you're going to use in your analysis because it can make a big difference. This is an important number in this class. Okay, let me pause. Okay, we're going to go through 3 or 4 problems here. So again, hopefully you've printed this out because I'm not going to go back and forth between the solution. But what I have right up here is I've written this on it with my mouse, so that's why it's pretty ugly there. But I'm going to ask myself, does the cost happen in the factory? If it happens in the factory, it's a product cost. And if it happens in the happens in the showroom or the administrative building, it's a period cost. So I'm going to first ask myself, is it a product cost or period cost? Then if it's a product cost, is it direct material, direct labor, or manufacturing overhead? These two are direct, and this one is indirect. Okay, these two directly get into the product. This one indirectly gets into the product. So obviously electricity doesn't get into a product. It is part of a product cost, but it is not directly in a product. And then down here, a period cost, etc. Okay, so Best Breads manufactures 2 types of bread, which it sells as wholesale products to various specialty retail bakers. Each loaf of bread requires 3 steps. I first mix, and where they combine all the necessary ingredients to create the dough. Then the dough is left to rise before baking. The second step is baking. So now it goes from mixing to baking, and this describes how you bake it. And the final step is finishing, which is an entirely manual process. The finishing department coats each loaf of bread with a specialized glaze and allows the bread to cool, etc., etc. So right here to here, that's in our factory. We mix it, we bake it, we finish it. Okay, so now we're going to go through each of these problems, and we're going to figure out, better get rid of those. Okay. So first one, we're going to figure out if it is direct variable, direct fixed, so whether it's fixed or variable, or indirect variable or indirect fixed, assuming the units of production of each kind is the cost object. So basically our cost object is a bread. Okay, so first of all, it looks like we might not have any period costs in this one. Okay, so we'll just go through the yeast. The yeast actually goes into the bread itself, so it is a direct up here, so it's direct and it's variable. The more bread I make, the more yeast I have. Flour, same thing. The more bread I have, the more yeast, or the more flour I have, so it's direct variable. So it's a product cost. Next one, packaging materials. Packaging materials depends on, honestly, if you're packaging 1 loaf of bread or if you're packaging them in huge crates, etc. So depending on how you interpret this, but it is certainly a product cost because it's the bread wrapper, etc. So it's either direct if it's the bread wrapper, or it could be indirect if it is like the trays that they haul it in, etc. So we'll just assume it's the bread wrapper, and so it is direct and it is variable. However, you could say it's indirect if it's very small. So again, look at some of this the solutions. Depreciation on the ovens, it's certainly a product, but it doesn't go in the bread, so it's indirect, it's manufacturing overhead. Depreciation on the mixing machine, same. Rent on the factory building, again, product. It's not materials or labor, so it's overhead, so it's indirect. It is also fixed. I think I forgot the depreciation is fixed. Usually depreciation, we take the same amount each year, so depreciation is fixed. There is a way that you can depreciate based on units of output, then that could be variable. Fire insurance on the factory building, again, it's product, it's indirect, and it's fixed. Since you would pay the same fire insurance every year, it wouldn't vary based on the number of loaves of bread you made. Factory utilities. Factory utilities, again, are in the factory. Notice if it was selling utilities or utilities on the administration building or the selling building, it would be a period cost. But here, factory utilities are in the factory, so it's a product, it's indirect. Utilities, a lot of them are fixed. You could have some variable, so it could be a mixed cost. Next one, finishing department hourly laborers. They are direct labor, so direct and variable. Again, you could have sometimes labor as a fixed cost, but for the most part, we consider it a variable cost. Mixing department manager, he's in the product. He doesn't touch it, so it's manufacturing overhead, so it's indirect, and it probably is salaried, so it's fixed. Materials handlers in each department, again, if they're hourly wages, generally manufacturing overhead, they're indirect, they don't actually make it, they handle the materials. Now, you could kind of assume that read it as materials handlers actually make the product, in which case it would be direct labor. This one doesn't. But anyway, if salaried, they're fixed. If hourly, they're variable. Custodian in the factory, again, it's a product cost. They don't touch the product, so it's manufacturing overhead. So it's indirect and it's fixed probably. Their salary wouldn't vary based on the number of bread items you made. Night guard in the factory, same thing, indirect fixed. Machinists running the mixing machine, so basically they're direct labor, so we have a product. Generally variable, but if they're salaried, you could have fixed. Again, for most problems, if you're identifying this one, it wouldn't be a good multiple choice to say, what are they, and just give you one choice of variable or fixed, because you don't know. You'd have to be told a little bit more. So again, the question is, the more bread I make, does the labor go up? And we generally consider it variable simply because our span of time is usually yearly. Maintenance personnel. Maintenance personnel are factory, but they product costs, but they don't touch the product, so they're manufacturing overhead, probably fixed. Maintenance supplies for the factory, it's a product, it's manufacturing overhead, probably variable. The more, again, this is sometimes, some companies would consider this fixed, that they buy a certain amount every year. But if you really think through it, the more bread you make, the more maintenance that you would need, like oil for the machines, etc. So it would be variable. Cleaning supplies for the factory. Again, it's in the factory, so it's manufacturing overhead, so it's indirect. The question is it variable or fixed? That depends on what they clean. If the more bread I make, the more I have to clean, then it's variable. If you simply clean the same amount every night, then it's fixed. Now, the second one, if the cost objects were the mixing department rather than the production of each kind of bread, which of the preceding costs would be direct instead of indirect? So the cost object is now the mixing department. So in the mixing department, if I think of these, I'm going to play these here. So now I go back through and I figure out, all right, which ones actually are for the mixing department. So I have this one. This becomes direct instead of indirect. Mixing department manager is direct to it. Materials handlers in each department, so the ones in the mixing department would be it. Machinists running the mixing machine would be direct, and maintenance supplies, if I could separate them out. So again, they're just direct costs of that department. So if you think of like a column for each department, you would only put the mixing department manager salary under the mixing department's department and not under the other ones. So that makes it direct. So if you think about this school again, and I've got the School of Business, and I've got the science department, and let's say I have the music department. So let's pretend we only have 3 departments in our school. Okay, so if I only put it under the business department, that's my salary. It's direct to that. If we have the salaries of the science department, salaries of the music department, they're direct. If we have certain supplies, that probably science would have a lot more supplies than some of the other ones, that's direct. However, if I get to the registrar's salary, I'm going to have to allocate it over all of them so that it is indirect. So if you think about that, if you think about direct and indirect, direct is it only goes under that column because it only has to be specific to that. Okay, let's go through this other one. Variable costs, fixed costs, and relevant range. Gumball Candies manufactures job breakers in a fully automated process. The company recently purchased a machine that can produce 4,500 candies a month. So that's important. This is our capacity right here. Not really sure why it turned blue, but we'll get it. The machine costs $8,000, so I've got a cost. That's an important one. So hopefully you're writing these out here. So I would write capacity 4,500 there, and I would write machine costs 8,000. Part of the doing problems is getting rid of the words and identifying the important information. I will never do a problem without writing out important information. So far we'll have capacity of 4,500, a machine cost 8,000 straight line over 10 years. So 8,000 divided by 10 is 800, assuming no residual value. Rent for the factory space and warehouse and other fixed manufacturing overhead total $700 per month. So make sure you have that. So far. Okay, so I've written them down here. We have capacity of $4,500 per month. The machine costs $8,000, depreciated over straight line over 10 years, assuming no residual value. So 8,000 divided by 10 is $800 of depreciation. Rent is $700 per month. Again, these are fixed costs, so I have $1,500 of fixed costs so far per month. And then I sell 3,100 jawbreakers, my current production, and materials cost 40 cents per jawbreaker. Next year, my demand is expected to increase by 100%, so 6,200. And my materials cost, I'll get a 10% discount on the price. So 10% of 40 cents is 4 cents, so I pay 30 cents. So first one, the relevant range of the output. The relevant range of the output is the range at which fixed costs will stay at $800 and $700 total, so $1,500, and the range at which it's 40 cents. So obviously the range can't be 6,200 because my variable costs change. So the range of output is 0 to 4,500 because that's my capacity. Above 4,500, I'll need another machine. I don't know, I may need some more building space, etc. But right now I know I'll need another machine because the machine can produce 4,500. I also know it's not up to 6,200 because the price goes down to 36 cents. So my relevant range of output is 0 to 4,500. Okay, and each month, so I multiply it by 12. So 0 to 54,000 is my relevant range. What is Gumball's current annual fixed manufacturing cost within the relevant range? So my fixed is 800 plus 700 per month, so I need to multiply that by 12. So, 700 times 12 is 8,400. And then I have $800 of depreciation a year, so 9,200. Okay, so I should say that, I think I said per month before, but that's machine costs $8,000 in 10 years. So this is per month here, right here. So make sure. Okay, spell it right though. All right. Okay. So 700 times 12 is 8,400 plus $800 of depreciation is $9,200. The variable cost, annual fixed manufacturing cost within the relevant range, that's the 9,200. Annual variable manufacturing cost. So I have currently 40 cents a jawbreaker times, this is, again, I should have written that out underneath of everything that's per month and what everything is per year, because that can really mess somebody up. So 3,100 times 12 times 40 cents. So my variable is 14,880. Next one, what will Gumbel's relevant range of output be next year? Okay, my relevant range of output is got to be affected by the fact that I'm going to need another machine, so hold on. Okay, so my relevant range of output next year, they should have asked you first what you need to do. You first need to buy another machine. So I have 4,500 per month. Again, I wish I would have put per month there. And I'm going to double it because I have to buy a second machine. I can't buy a second machine that gets me from 4,500 to 6,200. If that were provided in the case, my relevant range would be 6,200. But I've got to buy another machine, so I have 9,000. This also assumes my building can hold it. So I have 9,000 times 12. So 9,000 times 12 is 108,000 jawbreakers. Okay, how, if all, will the annual fixed and variable manufacturing costs change next year? So I'll have a second machine. So I'll have 800 plus 800. A rent of 700 times 12, so I'm going to have 9,200 plus 800 of depreciation on the first machine, 800 depreciation on the second machine. So I'll have, my fixed costs will be 10,000. Variable costs will be, I'll make 6,200 jawbreakers per month, so 6,200 times 12. Times 12 months. I don't see that number here. I found it. 74,400, which is 6,200 times 12 times 36 cents will give us a total of 26,784. I want to pause this a second and go to a spreadsheet. So this is on an income statement. I have sales minus variable costs minus fixed costs, and we have fixed costs of rent and other overhead items. So my rent and other overhead items were $700 times 12, so $8,400, and my depreciation was $800. So my total fixed costs are $9,200. I know that I am going to sell 3,100 units times 12, and I get 37.2 units. So I have, the selling price isn't given to me, but if I had the selling price, I could have units times sales there. Now, getting in the actual spreadsheet. So let's say that I sold them for, I don't know, $1 each. Okay, so I have my 30 sales, 3,700 times $1 each. Get 37.2 minus my variable costs of 40 cents each. It's 14.8, and I have my fixed costs, etc. I change this over here to, and then I would have net income of 13,120. Notice it's not asked for. But the cost per unit, the cost per unit is 24,080 divided by my 37.2. My cost per unit is 64 cents. Okay, so that could help me set my selling price. The selling price was not given in this case. I'm just going to add it as $1. So now we have, let's assume that we can simply operate at capacity. Remember what our capacity was? Our capacity, I'll go look at the problem. Is 4,500 drop candies per month. So 4,500 times 12 is 54,000. If I sell them for $1, again, I just made that up. But the cost of the important things. So I have 54,000 times 40 cents. I still have my same fixed cost, but look what happens to the total cost per unit. It is getting cheaper because I'm spreading my fixed costs over the same number, a larger number of units. Okay. If I operate at capacity with my new machine, so notice that I have 8,400 still for the rent and overhead. My machine depreciation, I now have 2 machines, so I have $10,000 of fixed cost. My variable cost is 36 cents. So I can do this a couple of ways. Let me pause here. I put the wrong heading on it. I think your handout has the right one. Okay, so if I double my sales from 37.2 to 74.4, let's say my selling price is again $1. I have my variable costs are 36 cents. I have same rent and overhead. I have 2 machines, so I have twice the depreciation. And look what happens to your cost per unit. Now goes down to 49 cents, mainly because of this cheaper 4 cents and the fact that I'm spreading these $8,400 of rent and overhead over 4,000 of units rather than the other one. So again, I can play around with this income statement and change my units. So if I want to, let's say, I'm going to sell 70,000 units, 7,000, etc. So it's just a matter of making a spreadsheet and playing with it. This is called sensitivity analysis. So I'll pause that. Okay. I am going to go through this with them side by side. So again, hopefully you have it printed out. But we're going to prepare a cost of goods purchased and cost of goods sold. Prepare an income statement. So I want you to go back to the format of the income statement. This is a little bit out of line. This 240,000 should be over there. But anyway, my cost of goods sold statement is revenues minus cost of goods sold is gross profit minus operating expenses equals operating income. And if you look back at your very first page, I have put sales instead of revenues. So sales minus cost of goods sold is gross profit or gross margin, same thing, minus operating expenses is operating income. Okay, then the next thing I want to introduce you to is a cost of goods sold statement. The cost of goods sold statement, you need to know this. Is beginning inventory plus purchases equals available for sale minus ending inventory is cost of goods sold. Okay, you'll have to it printed out weird from the instruction manual. Okay, and then this is a formal statement right here. And this is a formal statement. And this is a formal statement, okay? This one is just kind of there to come up with my purchases number. So basically in accounting, every cost to get the asset ready for its intended use is added to the cost of the asset. So for example, if I buy inventory and it costs me shipping to get it here, I add it to the cost of the inventory. If I buy a fixed asset, a piece of equipment, and I have to have it altered or a building remodeled before I use that building, it's added to the cost of the building. If I buy stocks for an investment and I have to pay a broker's commission, that broker's commission is added to the cost of the building. So basically I need to figure out what my purchases cost me by adding all those costs that are added to get the asset ready for its intended use. And then sometimes I return some things and I have discounts on them. Generally speaking, a lot of us would just simply adjust our purchases line for it. But sometimes we like to keep track of it, and you keep track of it in a separate account So if I bought 195,000 but returned 82.5 of them, the portion I kept is that net amount. So I'm going to subtract these, and these are discounts. Again, a lot of people would only record the purchases net of the discount. So if you got something on sale, for example, or if you got paid off early, if you paid something early and you got to pay less because you paid it before the 10 days expired or the 2 days expired, most of us would record it just simply net, but sometimes a business likes to keep track of that. Another kind of thing I need you to know is this is actually needs to be moved over. It didn't copyright. So the 195,000 goes right here. And then obviously this is kind of messed up there too. And the 240,000 needs to be moved over so those numbers are lined up. So basically, if I have my format of beginning inventory plus purchases equals available for sale minus ending inventory is cost of goods sold. I want you to think of this, and I'll go into this in the next problem. If I started the year with 10 pencils and I bought 40 more and I only had 5 left, how many did I use? Well, if you think about it, your mind is going to say, okay, I started with 10, I got 40 more, that gives me 50 that are available to use. And I had 5 left, so I must have used 45. Beginning inventory plus purchases equals available minus ending inventory is number used. Beginning inventory plus purchases gives me available minus what's left gives me how many is sold. So all that is backing into it. Okay, so now I'm going to just plug these numbers where they go. Again, I'm going to ask myself, is it a product cost? If it's a product cost, it goes into cost of goods sold. Goes into cost of goods sold sort of indirectly because it goes into this statement first. If I always sold everything I purchased, I wouldn't need this statement. I only need this statement because I have inventory that some left over. So marketing and advertising costs are period costs. Period costs go in operating costs. So this is product costs here. And these are period costs here. Okay? So period costs, so I'm putting it down there. Notice a lot of times I'll just make a separate statement that adds the operating costs, lists them, and then just put the total there. Merchandise inventory, January 1st, so beginning inventory goes here. Again, if you set up the framework for these of the sales minus cost of goods sold is gross profit minus operating expenses equals operating income, especially if you have it on an Excel spreadsheet and you can add some lines there. And then purchases, you can say purchases plus additions minus subtractions equals good purchased, okay? So merchandise inventory January 1st, 33,750 is there. Shipping of merchandise to customers, it's a cost of getting the merchandise here, so I'm going to add it to my purchases. Building depreciation. Building depreciation, quite frankly, when we get into the next chapter, if it's on the manufacturing plant, it's going to work through here, or the next problem. But anyway, building depreciation there. Purchases, 195. General administrative costs is the period cost that's going down here. Merchandise inventory, December 31st, that's the end of the year, so it's going right there. Freight in is added, so it's right there. Hold on, I called this freight in. That's important to not get that mixed up, okay? This is not freight in, that is shipping merchandise to customers, that is freight out. Freight out is an operating expense. So if you think about it, most of the cost to get the inventory ready for its intended use is added to the cost of the inventory. So freight in is added to the cost of the inventory. Freight out is a selling expense. So that's down here and right here. So I should say 1,500 goes there. Sorry about that. Merchandise freight in, that's this one. Okay, purchase discounts. Purchase discounts, we bought it. We got a discount, so we paid less, so that's a subtraction. And revenues of 240,000. And I think I missed the returns and allowances. If we returned it, it's subtracted. Okay, so again, if you plug it in there, we have, first I'm going to do this one. The purchase is $195 plus my freight in is $2,025. Add it to the cost of the inventory. Then I subtract what I returned. I subtracted the discount, so this is my net purchases. That comes down there. I'm my beginning inventory plus purchases. So beginning inventory plus purchases equals available minus ending inventory is cost of goods sold. My income statement is sales minus cost of goods sold equals gross profit or gross margin. So sales minus cost of goods sold is that. Minus my operating expenses of $42,650 gives me my operating income. Okay, now I'm going to actually stop this one and finish on the next video because I have to go someplace.